Hi, I'm Grant Abbott. I'm Principal of SMSF Strategies and also Chairman of the Australian SMSF Members Association. Over the past year I've been travelling all across Australia and talking to crowds on behalf of financial planners or accountants who specialise in limited recourse borrowing arrangements or SMSF borrowing arrangements to acquire property. Now, the thing that gets the crowd really excited and motivated, particularly if they're property investors, is how to transfer property from outside into our superannuation fund. So let me give you the drill on exactly how it's done. First off, we need to have a really modern self-managed superannuation fund. We need to get a modern deed. I've spoken about this many times. SMSF Strategies Trust Deed, 2012 version, absolutely a must-have. What we need from there is also then to have a set of property outside. Now, the rules inside the tax laws and also the superannuation laws say, unfortunately, we can't transfer property that we own or our family trust owns or our family company or a relative owns into a superannuation fund unless it's business real property. Now, what's business real property? It includes a farm. It includes effectively a factory. It includes an office. It includes basically anything that there's a business involved with. It would include an accountant's premises. If you're a land developer, it would include land. If you're a property developer, include trading stock. We're seeing a lot of trading stock of developments where property developers can't get rid of it, moving into superannuation fund. When it moves in, a market value pricing must be paid. What's also important, the Commission has come out about 2 years ago and said that if you're a residential property investor, you may be of the scale and the nature of actually treating that residential investment properties that you may have as being effectively business property. Once you get up around about 4 to 5 or 6 or plus from there on, you're spending a lot of time on those residential properties. Even though you might have a property manager, if you're treating it like a real business, then they may well become business real property and they can be transferred into super. So let's draw the line there. Work out first off if you've got business real property. If you think you may have, you can either come to SMSF Strategies or go to an advisor and they'll be able to sort you out and tell you whether you have got business real property. I always like to have a crack, have a shot and see where it goes. But once we've got it there, we can then transfer it into our superannuation fund. If it's in our own names in Western Australia and also luckily in New South Wales, there's no stamp duty on that. The other states you'll just have to check. Victoria, you might be able to get away with it. Now, importantly from that position, when we transfer it in, we can either pay for it, that is the super fund, if it's got the cash, can pay for it. If it hasn't got the cash, then what we can do is we can contribute a portion of that property in. For example, let's say that I've got a $2 million farming property there and I want to transfer it into our superannuation fund, our self-managed super fund. Mum and Dad currently own it, they're in New South Wales, and effectively what they'll do is they'll transfer it in. You may know the contribution laws. They say that you can put in $150,000 of non-deductible or what we call non-concessional contributions, or you can use the 3-year bring forward rule, which means you can put in $450,000 in any income year. Well, for Mum and Dad, they'd both put in $450,000 each, which means $900,000 would go in as a contribution. We transfer the title of that property into a holding trust. The legal title is held on a holding trust. If you're not sure what I'm talking about, go and see my video on how to structure one of these transactions. That means that the super fund owns equity of $900,000 in that particular holding trust. Importantly now, the super fund owns Mum and Dad $1.1 million. Now, this is what will happen is they'll have to pay effectively interest to Mum and Dad, but as I've said before, you can have a discount rate, Reserve Bank cash rate goes back to Mum and Dad. But effectively what will happen is that when we come up to the 3 years, that 3-year rule that we talked about is off and it's over. What we'll have in that sort of situation is that Mum and Dad will then go to the trustee of the fund and say, well, you know that $1.1 million that we owe you? We're effectively forgiving $450,000 of that. So at that point in time, we do a deed of release of $450,000 each, and that means that our borrowings move from 1.1 down $900,000 down to $200,000, and then we wait again, and then effectively over a period of time we're paying off all of that borrowing and our property ends inside our self-managed super fund. So that's how we get our business property into our superannuation fund, how we fund it, how we do it all structurally. Mind you, if you've got a business property in your business, think about it, you may want to refinance it, get a bank to lend on it. Banks will lend on that commercial property up to around about 65% and put that in there, get some cash out of your superannuation fund or the bank in order to put it inside your business. Again, a very effective strategy for a lot of developers at the moment, or anyone who's got a business that might be a little bit cash strapped. Anyway, that's how we get our business property into our self-managed super fund. Don't forget about residential property. Great strategy, very exciting. Gets me motivated every time, and I'm sure it's getting you motivated as well. It's Grant Abbott, Chairman of ASMA, signing off.